Welcome to Disruptive Successor, a show for next generation leaders in family businesses and entrepreneurs who want to disrupt the status quo and take their existing business to a whole new level. We all know that what got us here isn't going to get us there. This show will provide inspiration, advice, and resources to help you create massive impact. This podcast is sponsored by myself, Jonathan Goldhill, and my company, the Goldhill Group, where we provide coaching for growing companies. I'm Jonathan Goldhill, and my purpose is simple: to guide entrepreneurial leaders in family businesses towards more freedom and fulfillment. I want entrepreneurs to get clarity around the changes that will make them and their businesses more successful so they can experience the same freedom I've enjoyed in my life. Our proven practices challenge business owners to think differently about their business and how they're running it, and quite literally become game changers in our clients' companies. Learn more at thegoldhillgroup.com website, where you can schedule your free strategy session. It's Jonathan Goldhill, and welcome back to another episode of the Disruptive Successor Show. Today, I have a guest who's returning for a second visit. His name, I welcome back leadership coach Steven Wilkinson, who appeared with me on episode 50, where we talked about visioning for entrepreneurs. Steven is the founder and managing director of Good and Prosper Limited, based out of Ireland. With 35 years of investing and company leadership experience, Steven is an advisor to owner-managers of mid-market companies in transition and growth. Steven, welcome to the show today. Thanks for coming back.
Nice to see you again, Jonathan.
Yeah, it's awesome to see you too. And you hail from just south of Dublin, so across the pond.
Rural Ireland in County Wicklow. Yeah, but I spend a lot of time in the States.
Okay, awesome.
I get to do both.
All right. So, well, let's start with, what an interesting name, Good and Prosper. Tell us a little bit about that name. What's the significance of it? What does it mean to you? And what's that business all about?
Thank you. I set up the company when we moved to Ireland about a decade ago. I'd spent most of my career in Germany, working at the edge of finance and mid-market entrepreneurship, so Mittelstand businesses. And I was always having this discussion, particularly in Germany, which has a very odd relationship to business and capitalism. And there's always a discussion around the ethics of business, whether business is basically exploitative, which for a company that has built its entire wealth in the post-war period on small business and export is a strange mindset, but it's very much the mindset of old Europe. This idea that business is somehow evil and needs to be combated with lots of laws and regulations. And if you let businessmen do whatever they want to do, it'll all end in brutality and exploitation. And my mindset is quite the opposite. I'm a dyed-in-the-wool capitalist and probably on the libertarian spectrum.
Okay.
And I have found that the very best businesses are the ones where the people behave the best, where there is a long-term thinking, where there's a culture of doing the right thing, and that there is not a choice. The choice between being good and being prosperous is a false dichotomy. It's not true. In fact, the opposite is true, that the better you are, the more prosperous you'll become. And at the heart of it, whether you're good or evil, business responds to the same basic disciplines. But I found that people who are good at business and good in business tend to do much better than the people who are good at business but not very good in business.
But it's just like the double bottom line, like being,
No, it's much simpler than that.
Okay,
much simpler than that, and it has to do with, the name Good and Prosper. I chose it because, firstly, I thought it was quite clever to have a a name that sounded like Good and Proper, which means doing it well.
Right.
And if you're going to do it properly. But Good and Prosper allowed me to have a hook to hang this conversation on around being good in business, being good at business and being good in business. I mean, good at business means knowing how to be successful in business, how to run a business, how to be financially literate, and that's free of ethics, more or less.
Mm-hmm.
And then there's being good in business, which is how you are as a human being in your relationships and in your time preference and in what you do with your profits and how you set your business up for success. And those are important conversations to have. And I wanted to use a name that put that false dichotomy right in the center of things.
So is that a part of your leadership coaching work? Do you bring this to the front of a conversation, a relationship, and talk to them about these types of things, or not so much? Is that just in the background?
Not as yeah, it's in the background.
Okay.
And I twitch when you use the word coach because I'm not one.
Oh, okay.
I don't think, because we had this conversation before you press record around the difference between an advisor and a coach. I think a coach, in my mind, a coach is more programmatic.
Yes, like has a playbook kind of a thing.
Has a playbook.
Right.
And I don't think I do.
Okay.
And I think where I am paid by leaders to support them in an advisory capacity, it's usually because I will have a perspective and an opinion and play devil's advocate without framing it in a way that I'm not having an opinion, if you know what I mean, so that they reveal the truth themselves. I'm quite happy to shortcut that.
Right. But do you think of coaching as Socratic, where it's just question-based or inquiring or appreciative inquiry, and you and I differ on that, but I think this is maybe semantics for listeners. They're like, because they don't even know the difference between coaching, consulting, advisory. Most of them, it's all to them. It blends together, and I think for many of us today, it blends together. Sometimes you're wearing coach hat, sometimes you're wearing advisor, sometimes you're consulting. But maybe it's most coaching is most akin to like sports coaching, where there is a playbook and you run your franchise a certain way. And no matter what franchise you go to, you take that playbook. And, so if you go to an opposing team, the team that you came from, they probably know what the playbook is because you run the certain type of offense or defense or, well.
Yeah, I'd like to think that I'm wholly bespoke, but I'm probably not, because my playbook is rooted in two things. Number one, a deep understanding of financials.
Mm-hmm.
Where I've come from. So, I can take, if somebody gives me 3 years worth of financials and gives me 10 minutes, I've got a pretty good idea,
right,
of where it hurts. It's I don't have to do too much diagnostic to ask 2 or 3 right questions and get to the truth of where the business is. Number one.
Right.
And number two, I think I have a very good understanding of different business models,
mm-hmm.
of how the financial model and the market model of the business is within the context of its industry, other industries, and where there is possibly dissonance between how they are thinking about their business and how it actually should be functioning. So within those two aspects, I will tend to frame at least the initial conversations around any business and any owner who's sort of suffering from whatever it is, issues with growth, issues with leadership, issues with entropy, issues with, I don't know, whatever it is.
Mm-hmm.
I will tend to find the source of those pretty quickly in the financials or in the business model that's not quite aligned correctly. So I'm listening to you talk and explaining what a how a playbook in sport works. I think I probably do have one, but once we've established that, I'm very bespoke.
Okay. Understood.
And I think my background, because my background has been as an investor and very often a board member,
Hmm.
and on numerous occasions also chairman of a board. The That's how I've, because I probably don't know any better. That's how I've always framed my engagements as a in the role of a chairman, even if there isn't a board there. And the chairman has a couple of very clearly determined objectives. Number one, strategy.
Right. Of course.
Be a very strong, robust challenger of the core strategic decisions that are going to determine asset allocation, resource planning, and overall company objectives within the context of the marketplace and the business. So that's number one. Number two, financial integrity. Number three, governance in its broadest sense. And number four, and I'm going to say it's probably the most important, is having the CEO's back. In other words, making sure that
Yeah.
the CEO, the owner of the business, in most of my cases, in fact, in all of my cases, that the CEO, who is also the owner, that they are looking after themselves and watching out for them holistically, making sure that they're okay. And when things get tough, standing by them unequivocally. That's part of the
That makes
chairman's
sense.
job, is
Yeah, I think so.
standing right behind them, giving them support. And if you don't feel you could do that, then you shouldn't
Yeah,
be in the position.
correct.
Then you need to leave.
Right. So,
Yeah.
one of the questions that we talked about before we hit the record button was, and you were alluding to business model, but why it's critical to know what you want your business to become. And by business model, um, that could mean many things. But one of the things that you alluded to in our call earlier was, are you building it to sell? Is this a lifestyle business that's just a moneymaker for you? Do you want to be a small giant? Is this a moonshot? Like that to me is part of the business model. It maybe, it's different than the product or the service model, but it's really like, what's your vision of what you want to become? And is that part of what you mean by business model when you say that, or are you thinking different terms?
No, but they're joined at the hip.
They are. Okay.
The business model is the financial model itself.
The way you make
So
money.
how
Yes.
does this business make money? What are the
Right.
input variables? What can you control? What can you not control?
Right. Okay.
How how, how could you think differently about your business by applying a heuristic from a different industry? So some of the biggest breakthroughs that I've seen business owners have is when they they change the perspective on what is possible in their industry. So
Hmm.
maybe they come in and they're used to an industry doing it this way.
Yes. Yes.
And then you say, well, what happens if actually you're in a different business? Maybe you're not in the business that you think you're in. Maybe you're in this. And if that's true, what are the rules of this industry? And then they look at their industry and say, well, actually, if I rethink my business in terms of a different industry, then I get to do all sorts of different things. I have different priorities. I have different margin
Right.
structures. I have different input variables. And that can be profoundly powerful in terms of changing a business for the better. So
So I
that's
understand.
what
So like that's one of the roles that advisors or coaches play is holding up a mirror, showing them what they're doing and maybe how it's similar to what everyone else is doing, and then bringing knowledge from another industry about what's happening in that industry, and then
absolutely.
questioning the assumptions they make about their industry, about the way business is done. And I'll give like an example. you know um, in some industries like what we do, Uh, Customers, clients always pay typically in advance of the work being done. Um, and in other industries, they pay net 30, net 45, net 60. Um, so looking at the payment terms can be very challenging. And a great example, a story that comes right out of the scaling up literature is what Dell did when it
Sure.
changed its business model from, oh, everyone's going to consign their goods. We're going to get it just in time. We're going to collect from the customer in advance of them, with the order that they make, and then we'll deliver it. So basically, the customers and the suppliers are going to provide all the financing to grow this company. And they turned their cash conversion cycle from like
It's a
minus,
negative.
yeah, to a negative. Um,
Yeah.
it
And
seems difficult to do that.
everybody quotes Michael Dell on that
Yes,
one,
yes.
and I know very few who actually do it.
hmm Because it's so difficult. Because people are
Yeah.
afraid that they'll lose, they won't make the sale in the first place, or it's too
Right.
difficult of a, they don't, the value that goes along with that change, you can't just make that change without also offering some much greater value, and they don't necessarily know how to, close
Well,
that gap.
who does that as a matter of course? It's not industry, it's size. All big business
Right,
finances its working capital out, all of them. The
right.
reason that they're paying you net 60 and stretching that to net 75 or even 90 is because they're doing that.
hmm
They're paying their suppliers net, with net
Right,
45.
right.
And so small business, one of the things that small business does is finance big business.
Interesting,
That's
right? Yeah,
full stop.
yeah.
One of the major sources of capital for large business is the working capital loans that small business extends to them. Which, you know, when you think about how markets should be structured and who has more power and who needs the money most, it's ridiculous.
Yes, it's the other way. It should be the other way
But
around.
it should be the other way around, but it isn't.
Right, right,
It's not.
right.
And banks make a huge amount of money. Not only do they make large amounts of money doing the securitization of the capital market
hmm
front to big business, they also make a great deal of money on those net 20, 30 days.
Right, right. The float.
Because
Yeah.
where else is a small business going to get it from except from banks and the capital market? So
hmm
there is small businesses are paying through the nose for their working capital, and in the process of doing it, they're making banks profitable and they're keeping large businesses in net negative working capital terms. So what Dell did instinctively, he was arbitraging between customers' need for the product, which
Yes.
they were so small. The B to C part of it, he knew that the C's would pay immediately because they're not working capital sensitive. But people don't think like that. They want the computer, and if you have to pay up front, you have to pay up front. So you put the money down, you get it. And he pretended from day one that he was a big player vis-a-vis his suppliers. And he knew that if he concentrated his orders and got volume flows getting up quickly, that they would believe him that he was a big customer, even though he was putting little orders in to start with. So he arbitraged that in a way that few can. The other person who did it was Sam Walton.
Mm.
Sam Walton
Explain.
built his business on the back of pretending that he had volume when he didn't, and using that volume to generate discounts and extended payment terms, while at the same time pushing people into the stores with attractive pricing, which effectively got his working capital, if not negative, then at least he was not paying enormous sums to expand his business.
So
So
what you're saying, in part, is that our self-concept in business of who we are or who we want to become plays an important role in your strategy. If you are if you have a self-concept that you're building something really big or you are something really big, it's the David and Goliath kind of a story, and you can act like a giant because you think you are. It's punching above your weight, and that's an important role. I mean, we may have talked about this in the visioning episode, but it's an important role. Vision plays an important role in driving your success. Yes,
I agree. And knowing what you want, which is sort of at the heart of vision, being intentional.
Mm-hmm.
And it makes a huge difference. There's no right answer to this. You can be, and I'm just using these three categories arbitrarily, and I'm sure there are others, but I don't know what they would be. But you could, if you're a small giant, you're focusing on human scale business, on personal connections, relationships, and the integrity of your business, but you're not looking to scale. So
right. And a lot of family businesses that are like small family businesses that are just trying to survive and be successful, and they're not.
Well, and I think that's a big difference. There's a big difference between just surviving and being successful.
Exactly.
So I think the answer for all business has to be over time to thrive.
Yes.
To be successful. If you're not in it to be successful, then I would humbly suggest you've probably just got a job.
Right. But I guess successful, but there's sustainable and then there's successful. And successful suggests that they're innovating at a much faster rate than those who are just sustaining.
No, I don't think that. I wouldn't agree with that. I would say that those who are successful are doing something so specific that and at a level of quality and competence, that their gross and net margins are above average within the context of their industry. And therefore, they are doing something right and sustainably right, whereas most of the other people in their industry will be surviving or dying. Now, I was involved in a study that looked at 5 years worth of EBIT margins in 10,000 small to medium-sized businesses. And they were a minimum of, I think, up to 50 million in revenue and up to 250 employees. That was sort of the basic definition of a small, medium-sized business. And there was one incontrovertible piece of evidence that flowed through the entire study, and we split it into, 30 or 40 industry groups and did this very detailed financial analysis of all these 10,000 companies. And what came out was that the difference between the top 10% and the average in every single industry was factors of 5 to 10 in terms of their profitability, not 5 percentage points, but 5 to 10 times as profitable. And the average across all of the industries was 17.6% EBIT margin compared to 2.7 for all the companies, including the top 10%.
Right.
So if you take
let me just explain this to our listeners in more plain speak, which is, and I learned this in the early, probably 1991, when I picked up a book that was written by, well, it's not like a reading novel. It was basically a bunch of financial statements, like over 100 of them. And it was put together by Robert Morris and Associates, which is now, it's still called RMA, but it's Risk Management Association. And it's all these industries. And it showed the net profit, and it broke down income statements and balance sheets of different size companies. And the average net profit of most companies is 2%. And many companies lose money. So this was quite a revelation and a shock when I shared this with other people, because most people who are successful think, no, you make at least 10% or 15, or if you're doing really well. And the truth is that's not true. The average company makes about 2% net profit. And so I know,
and the average
Is
includes that top 10 to
yes,
15%
exactly.
who are
Yes,
making all the money in that industry sector.
exactly. It's the
All of
old,
it.
it's not even the 80-20 rule. It's more like the 96-4 or 90-10 or something because
90-10.
yeah. And so one of the things that I promise as a brand, as a coach to my clients is you'll get 3 times industry average profitability. And I can say that boldly because so many companies are making 2.5% net profit. So if
And,
we can get to 10, then we're, and that's looking pretty good. If we can get to
and when,
15 or
when,
20, that's really innovative.
when we asked the top 10%
Hmm.
what they thought the reason was that they were more successful than the others,
And
they said because we're highly focused
right,
on solving problems for a very specific client or
right,
industry segment of the market.
right.
And they said, and our financial results are not an accident. We plan for them. And when we asked the 90%, sort of a cross section of the
Yeah.
90% who weren't in the top 10%, why they thought that their results were different from the top 10%, almost all of them said, well, you can't really compare us with that. And we would say, well, why not?
Why?
Yeah, because they're so specialized.
Right.
To
Oh,
which the answer is, well, why
why aren't
don't
you
you do
too
that?
specialized? Okay.
Yeah. And they weren't planning their financial results. They
Hmm.
weren't, they did not benchmark themselves against a particular balance sheet structure, a particular margin structure, and then work and do whatever was necessary to get to that margin structure that they had set themselves. So the top 10% that don't get to the levels of profitability that they achieve by accident. They do it through disciplined planning around constant improvement of their margins and by specialization. And that's fascinating. And my take from that was that in small business, the returns to competence, so just doing a few things a little bit better than everybody else, already tilts the game massively in your favor because most people are doing it badly. They're not focused, they're not financially disciplined, they don't have good governance, they're not applying the very tight resources that they have specifically, they're not making incremental gains, they're not measuring those gains, they're just getting along. And
And they're making excuses or they're living in a world of maybe excuses
yeah, and there's
as, as opposed to
absolutely.
taking
And
ownership and agency over who they could become.
and and there's an interesting corollary to that, and that is if the average company is really not making money, then it has to follow that anybody who is looking at the rest of their industry for pricing guides is pricing for failure.
Hmm.
And that understanding and taking control of your own pricing strategy is one of the, I'm not going to say the easiest, but it's certainly one of the quickest ways to improving the margin structure. Because if you're looking at what everybody else is doing in their pricing, and you're not differentiating, and you're not specialized, and you don't understand how you are adding value to your whatever it is that you're producing or serving, then you will be sucked into the average pricing. And because we know that the average is losing money, or at least very best breaking even, well, then you're pricing yourself for failure. And
Makes it
that's
it makes sense. So so you have an interesting concept about owner manager and owner and um, talk to us about what you see the difference. What's an owner manager versus an owner?
well, it's often an owner manager is somebody who owns the business and runs it.
Hmm.
And they combine two different roles, one of which gets really short shrift.
Okay.
So the
Yep.
owner manager is spending 99.5% of his time as a manager and not
Right.
as an owner.
Understood now. So This is akin to the Robert Kiyosaki, model. If you're familiar with the
I am.
Good Dad,
I understand his sort of cash flow quadrant model,
right?
and I find
Exactly.
that's a useful heuristic.
Mm-hmm.
But here's the thing: as a small business owner, or as a business owner, if that's your job, running that business, you have two very distinct roles, and they are often in conflict with each other.
Yes.
And you will always make decisions as a manager that will be to the detriment of your position as an owner. So if you had a separate owner, if you were just working for somebody else whose business it was, and you were running out of cash, well then if you had to go to your owner and say, can you just stick in $50,000 on Monday because otherwise we can't make payroll, and not take any account of that, and said, just I'll pay you back sometime. And we'll just give it to me. And I'm not going to charge the interest, and I'm not going to just because I need it.
Mm-hmm.
That's what a lot of business owners do. They do that. And by doing it, they're violating their position as owners of the business. So they never really know they never make decisions about capital allocation. There's no discipline around returns on capital. They don't look at their balance sheet because they're constantly fixated on their cash flow. And even the way they look at cash flow is different from the way an owner looks at cash flow. An owner looks at cash flow as financing from operations, financing from investing, financing from financing, and looks at how the business is generating and allocating funds, A, to the balance sheet, and B, to the future, and seeing how much operations is contributing to that. That's not how managers think about cash flow at all. Cash flow is the 12-week running forecast of where the money's going to come from. It doesn't differentiate between financing and investment unless things are really tight. And so the owner, thinking like an owner, means thinking like my business as an asset. And the only way you are ever going to sell it is by building it so that it works as an asset rather than as a job with benefits.
Yes. Well, and the balance sheet is just not looked at by so many small businesses. No. They don't look at it. They don't think about it. They don't understand it. And, cash flow is basically just about making sure they have enough money in the bank to pay the bills. And most of them don't ever produce a cash flow statement unless they get to the point where it's so tight. And then they're desperately trying to figure out how to forecast cash flow.
Yeah.
For so many. So
I entirely agree.
Yeah.
And you start becoming an owner when you start spending a bit more time looking at the balance sheet. You can't help it.
Yeah.
Because you cannot calculate the intrinsic value of the business without starting with the balance sheet. And in fact, I learned from a very early age. I would come from a business family, and I have a couple of generations of ancestors who were deeply involved in commerce at one stage or another. And I learned from a very early age that you can tell whether somebody's an owner or a manager by whether they look at the income statement first or the balance sheet first.
Interesting. I like that. All right. So what are some of the systemic mistakes in business and personal life you think entrepreneurs need to avoid?
Well, I'm going to say flippantly, people going into business, one thing they definitely need not to do is to imagine that success is something that comes at a flick of a switch, and that one day you go from years of struggle to your yacht with a sort of, it happens in a week or a month, and then you move from this stage of everything's a problem to nothing's a problem. Well, because I learned, again, from a friend of mine who runs a very successful business. He says success in business is the art of getting better problems.
Better at solving problems. I mean,
no, not better at solving problems, but getting better problems.
Oh, better problems. Okay.
So as your business grows, you get better problems.
Gotcha.
You don't get no problems.
Okay, understood. I mean, we used to say that companies like Starbucks or Apple, they were a success story 25 years in the making. And if you look at their stock price, or if you look at their history, I mean, Apple almost went bankrupt, had to go to Microsoft to borrow money. Starbucks took many years before it got to 100 stores, and then it took less years to get from like 100 to 1,000 and then to 10,000 stores. I mean, so these are, we look at these and historically they look like they popped up really fast, but they took a long time and almost multi-generational to become really successful.
Sometimes, yes.
Yeah.
Yes. Sometimes that's true. I mean, usually you can see the start of the exponential trail in the founder's lifetime. It has to, actually, otherwise.
Right.
But it can come in it usually comes in the latter third, not the first third. And the successes that we've seen in recent times with new technologies in sort of the last 20, 25 years, that's an anomaly.
Yes. Like the Ubers and the Airbnbs and the cryptocurrency and the AI bubble. I mean, we've seen companies get to $1 trillion in market capitalization faster and faster and faster than ever in history. And it seems unthinkable. A lot of it's fueled by the capital markets that support
all of it is.
The growth. All of it, right?
All of it is. Yeah. So
yet these are bubbles that can just burst, and things can change very quickly, right?
Oh yeah. There's there is a 95% rule that all the high flyers, if they don't go bankrupt in the first down leg of a bear market, will go to 95%. Will lose 95% of their value at the peak.
Right.
You just have to look at Amazon went from 122 in the spring of 2001 to $6.50. It's a 96% drop in the value of its share price.
Wow.
They were 3 months away from illiquidity, which would have forced them onto the back foot. But they were, and there were all sorts of other businesses at that stage that went to 100% loss, and deservedly so. But and we'll see that again. I mean, that happens regularly, sort of 20-year, 2-decade intervals.
You see the 2-decade interval. So explain that.
Well, there's an underlying rhythm to capital markets, which is about 18.6 years. 14 years up, 4 years down. 14 and a half years up, 4 and a bit years down. So you look at the last cycle that ended in 2008. So if you take 2008 as the peak of the last one, 2008, we had October 2008, and by the beginning of 2012, it had bottomed out. We were starting to move up again. The 14-year upswing is marked by 2 7-year periods with a break in the middle, roughly. So beginning of 2012 to 7.25 takes you into March of 2020. Guess what happened then? We had a break in March of 2020. Short one, we were back off to the races about 2 months later. Once we sort of got the handle on the COVID pandemic, and we are now in we're about halfway through the next phase in 2024. So if you take sort of 19, roughly the end of 19, and add another 7 years to that, you get to 26, which takes you to the top of the next cycle, which is exactly 14 years. So the end of 2026, if you follow the rhythm that the US stock market has played out for about 220 years, with an interruption for the Second World War, which extended it slightly, you've got a very reliable 14.5 years up and 4.3 years down, which means the second half of this decade is probably going to be a fairly difficult one. And all of those shares that you were mentioning that have gone sort of in bubble type valuations, they disappear there.
Right. So And so how does this play out for the average business owner or manager or investor? I mean, I know we're looking at an AI bubble that might burst. We're looking at a bubble around fiat money with the cryptocurrencies seemingly, I think got to $1 trillion market valuations in record time. How does this affect the average business owner running their business?
Well, the question that I'm asking people is, if you knew right now that today you're in 2006 and you knew that 2008 was coming, what would you do? How would you have wanted your business to be positioned in 2008? Given if let's say just assume that 14 years later, it's more or less the same business.
I mean, you might divest of certain real estate assets, I would think.
You
If you could.
you probably deleverage, wouldn't you?
Absolutely. Yes.
So you'd be looking to pay down your lines of credit. You'd be looking to make sure that if you did have lines of credit, that you were covenant safe,
Mm-hmm.
and extending your maturities out as long as possible if you couldn't completely liquidate them.
Mm-hmm.
You would be looking to make sure that your working capital, accounts payable were your accounts receivable, sorry, were good. You would be trying to get as much money from the ones that were bad payers. You'd be trying to improve the quality of your AP
Mm-hmm.
rapidly. You would not be extending you would not be extending credit
Right.
to dodgy customers.
Mm-hmm.
You would be probably, if you have inventory, you'd probably be running inventory down towards the top of the cycle to generate cash, on the assumption, if you could see through what was happening, inventory of pretty much any sort was cheap in 2009. You could pick up stuff that you paid a premium for 6 months earlier. You could pick it up at a discount 6 months later. You would be paring back expenses and staffing going into it. You would be preparing your team for bracing for impact. You'd be doing fire drills. You'd be making sure your bankers knew that you were in a good position, etc., etc., etc. You'd be doing the fire drill, and if it was and that's where we are. We're now in the equivalent of 2006. Now go back to 2006. 2006, we were having a party. 2006,
sure. Right.
Interest rates were coming down. We were the land, or the securitization bubble it was experiencing the first twinges of stress. But 2006, we were off to the party. Nothing could go wrong. There was going to be, Bernanke had said, there's no way this is ever going to stop, and house prices always only ever go up. And we've got another 2 years before equity prices didn't peak until October of 2008. And then they crashed, in 3 or 4 days, and it was over.
Yeah.
Interestingly, and this is always a great sign, the corporate bond index always shows stress long before the equity markets do. So if you're looking at, I don't know,
and are we seeing that now today, do you think?
No, not yet.
Okay.
Not yet. We've got a big party ahead of us. 2024, second half, 25, and the beginning of 26 are going to be stock market boom years.
But corporate bond, but we're not seeing that with like government treasuries. I mean, that's been flat for a few years. Yeah.
Yeah, it has. And if you look at the iTraxx corporate, triple B minus iTraxx index, which is a good proxy, you will see that spreads are relatively stable. They're quite tight. There's not much risk premium in those markets. And when the crisis comes, that spreads goes out to about 1,000 to 1,200 basis points. You're going from spreads of 30 basis points to 1,200 at the peak, or 1,250, I think, was the peak in the 2008-9 debacle. I mean, that tears the guts out of the corporate bond market. And risk is suddenly priced at an extreme levels of premium or discount, depending on which way you look at it.
Yeah, so I'm curious, you're on the other side of the pond from us, and you're looking at the US and you're seeing some pretty interesting political sea changes, I would guess. You're seeing a lot of disruption locally here and at college campuses, a lot of disruption, but you're probably witnessing political disruption in the US. And what's your perspective on that as far as how it affects small and medium-sized businesses?
Again, small and medium-sized businesses, they have to sail on the sea that they've got. They can't hedge. You can't hedge.
Right.
You can move to Florida, maybe, if you're arrested. You can live in friendlier states. And I'm sure there's a lot of migration going from California to Dallas, or to Texas, and to Arizona, and to Florida, and from New York to New Hampshire, but at the end of the day, there's not an awful lot you can do. You've got to ride it out, and the only way you can ride it out is by being prepared mentally. But I think mental preparation for massive dislocation is the big thing. I follow an interesting indicator called the 13 Keys to the White House. There's a guy called Lichtman, Lichtman, I think. If you Google 13 Keys to the White House, you'll find lots of articles. And he wrote a book, I'm going to say 10 years ago, in which his predictive model for whether the incumbent or the new guy takes the White House is based on 13 key questions, which you can either answer, which are binary, yes or no. And if whoever has a majority of yeses is going to take the White House, and he's not been wrong once.
Wow.
Not once. His model is entirely predictive, and he built it after a conversation with a volcanologist, somebody who was studying volcanoes. And he said, how do you predict whether a volcano is going to happen? And he said, well, we've got these 15 criteria, and if more than half of the criteria are yes, and they're simple questions, then we can have a very high level of confidence in our prediction that there's going to be an earthquake or not. And he said, I wonder if that would work for politics. So in the 1970s and the 80s, he started working on this model, and he's been remarkably, had a remarkably high level of confidence around his predictions. And at the moment, he's calling it too close to call. And there are four variables that he said, as those play out over the next 2 to 3 months, he will definitely be able to say in August which way it's going to go. And read it; it's fascinating.
Sounds like, I'll be checking it out. Sounds very interesting.
And my sense is that it doesn't matter who wins this election. It doesn't matter. They're going to inherit an economy that is being goosed through short-term financing.
Yes.
Janet Yellen has turned, 100 years of government financing on its head. She's now the Treasury is now financing 80% of its requirement with T-bills and short-term financing instead of 20%, which is what it's usually done. And only 20% now is term financing. In other words, 3 years, 2 to 30-year financing.
Right.
So you've already got to casino level financing. This is highly speculative.
Wow.
If interest rates stay where they are, the government interest bill goes to 1.6 trillion in a heartbeat by the end of the year. So that's not going to happen. They're going to bring interest rates down one way or another by monetizing them through the Fed. So America is already in overtime as far as its financial structure of its economy is concerned. Add to that the fact that we are already in the hot part of the Cold War preceding World War III, with the invasion of Ukraine. If we look back in 30 years' time, historians will say, oh, well, it's obvious when it started. It started then. And then they'll look to the conflict in Israel with Iran, and they will look to what's happening in the South China Sea with China. So my guess is that we will be at an increasing level of hot war by the time this cycle peaks. But there's something very interesting going to happen. And as I say, it doesn't matter who takes the White House. I don't think it really matters at all, because the financing mess is going to be there one way or the other. What nobody's talking about is that, and I think I can say this as an Englishman with a sort of a longer perspective on American history, nobody seems really to be talking about the fact that in 2026, you're having your 250th anniversary of the Declaration of Independence. And that's going to be a party year. Whether people are feeling like party or not, I think the stock market will be at its peak on the 4th of July in 2026. That would coincide perfectly with two of the major cycles, the commodity cycle, which is the Kondratiev cycle that peaks in 2026 at some stage, and the land cycle, that's that 18.6-year underlying rhythm of the market, that peaks in 2026. And we've got this generational cycle, sort of 80 to 90-year cycle, which is also peaking in the second half of the decade. So you've got all of these three waves, the short one, the medium one, and the long one, all coming together at a time of maximum fragility in US funding structure. And it's going to just rip the guts out of asset markets. We've had it so good for so long, and the Fed have tried have tried every crisis to try and to take it onto their balance sheet. But I think this time, because we've gone from an equity crisis in 2001 to a housing and corporate fund. It was a very specialized type of financing that almost destroyed the banking system. We now have a slow-burning commercial real estate crisis, which is going to be taken onto the Fed's balance sheet. But the next one is going to be a government funding crisis, and that's the mother lode. That one.
Interesting.
There's nothing above that. There's once you've gone from equity, which we didn't miss a heartbeat in equity, you can go through sort of funny money asset financing vehicles, which was the 2008 debacle. But once you get to government debt and government funding, once there is a crash in or a massive dislocation in that market, that trumps everything. So, and that's the next one. So, that's what we're waiting for.
Well, Steven, this is go ahead, finish.
So the second, small businesses, in every single crisis, there are always winners. There was always opportunity. But the only way that you get to continue playing in a field in which asset prices are sort of reverting to the mean and going through it on the other side is if you are well prepared. And I think the single most important thing is being mentally prepared. If you're mentally prepared for dislocation, you can ride it out. Then you automatically start reducing risk prior to the peak. And you've got 2 years time, I think, to get your house in order. Plenty of time to do all the things that we've been talking about. And then you can make hay in the time afterwards, or at least survive it, in order to sort of be well positioned for when it bottoms out again. But if in doubt, just look at 2006 to 2010 and say, what would I have wanted to do? How would I have wanted to position myself if I knew that was where I was today in 2006? And then just do that.
Very interesting conversation and questions. We need to wrap up. I don't know if we covered what we wanted to cover, but I thought it was a very interesting prognostication on the future of the U.S. And maybe you make some different choices based on these predictions, and maybe you start to understand, at least at minimal importance, that you need to squirrel away money when you're doing well and make careful asset allocation choices as a business owner.
I would agree with that. And if you like, I can give you some book titles of interesting literature to back that up into the show notes.
Sure, that'd be great.
Yeah, love that.
Thank you.
All right. Thank you so much, Jonathan.
Folks, that's Steven Wilkinson, Steven with a V, at goodandprosper.com. Reach out to him if you want some more info. And as always, thank you for staying tuned to the Disruptive Successor Show, and stay tuned for future episodes. This podcast is sponsored by myself, Jonathan Goldhill, and my company, the Goldhill Group, where we provide coaching for growing companies. I'm Jonathan Goldhill, and my purpose is simple: to guide entrepreneurial leaders in family businesses towards more freedom and fulfillment. I want entrepreneurs to get clarity around the changes that will make them and their businesses more successful, so they can experience the same freedom I've enjoyed in my life. Our proven practices challenge business owners to think differently about their business and how they're running it, and quite literally become game changers in our clients' companies. Learn more at thegoldhillgroup.com website, where you can schedule your free strategy session. Thank you for joining us on the Disruptive Successor Podcast. If you enjoyed today's episode, please subscribe, review, and share with a friend who would benefit from the message. If you're interested in picking up a copy of my book, Disruptive Successor, go to disruptivesuccessor.com.